Okay, it is now noontime. I would like to thank you all for taking time out of your day. I know where everybody's busy, but I think this is a really important topic to discuss, and I'm really glad that you had the time to spend with me today. So, my name is Rachel McKinley. I'm the Vice President of Marketing here at Maine Family Federal Credit Union. I am also a certified credit union financial counselor, and I am here to help you figure out if you or somebody you know are dealing with debt, how we can get that taken care of so that it makes your life a little bit easier. So I'm just going to go over our agenda real quick. First, we're going to start talking about getting prepared to tackle your debt. Then we're going to talk about 5 different options that people can use to tackle their debt and then cover some of the pros and cons of each. And finally, we're going to wrap up with some tips to stay on track toward your own goals around dealing with debt. First off, let's just take a look at how you get prepared to pay your debt off. Being prepared, like anything else, is probably one of the most important things you can do in this process. The first thing you want to do is get a clear understanding of your current financial situation. That can feel intimidating or really scary because putting everything out in the open for yourself to see, it can be it can be overwhelming. But knowing where you stand is imperative to debt-free success. Having that knowledge of where you're at will help you set clear and realistic goals and evaluate your options confidently. The first thing you want to do is start out by making a list of all of your income. It includes anything you can count on to come in consistently, which is your paycheck, child support, social security, etc. However you receive money, you need to know how much you have to work with each month. Make sure you're not including overtime unless it's guaranteed to be consistent, or that other income that might be significant or might be unreliable. Inconsistent income like overtime and side hustles can be used as extra money to reach your goals faster, but it's best not to be considered as part of your budget unless it's guaranteed. Review your checking and savings account balances so you know where you currently stand. Next, it's important to understand where your money is going. Review your statements to make a detailed list of all of your monthly bills and payment obligations, as well as anything else your money consistently goes to, such as food, gas, childcare, entertainment, subscriptions, and then other miscellaneous expenses. Take a look back over a few months to get an accurate representation of the average amount you spend in each area over time. Some online banking options will provide a breakdown by category to help you make this easier, and some budgeting apps will do the same thing as well. It's also important to make a list of all of the debt you owe, which can be a little scary if you do owe a lot. But it's very important to have that so you can really make a plan to break it down. Know who you owe, exactly how much you owe them, the current interest rate, the current monthly minimum payment, and if any of those are past due. I also encourage you to pull a copy of your credit reports from all 3 of the major credit bureaus, which are TransUnion, Experian, and Equifax. Reviewing your credit report can help you ensure that you have not forgotten anything, or maybe there's something floating around out there that you didn't even realize existed. It's recommended to get in the habit of reviewing your credit reports at least once a year, and we recommend going to annualcreditreport.com to review your reports for free from all 3 bureaus in one trusted place. And we also have an option here at Maine Family to help you stay on top of credit report changes by using Savvy Money, which you can get within our mobile banking or online banking. It's a free tool that shows you your credit score, and it also gives you your credit report so you can look at the history and make sure that all of the information on there is accurate. It even sends you alerts anytime there's a change to your credit report or score, so it helps you really stay on top of it. Each financial situation is unique, so these preparation steps can help you figure out which debt payoff strategies may work best for you. This is one of those things where it is definitely not a one size fits all solution, and every option comes with its own pros and cons that we should consider. We also know that paying off debt can feel overwhelming or even out of reach. It's not always clear what options are available, and it can be tough to tell what's trustworthy versus what's scam. So let's take a look at some realistic options that help make becoming debt-free feel more achievable. So today we're going to touch on the five main options to reduce debt: making a plan on your own, debt consolidation loans, debt settlement, also known as debt relief, bankruptcy, and debt management plans. Chances are you may have already been trying to pay debt off on your own, but without a plan, your success may have been limited. If you have money left over in your budget, a strategy to pay down the debt may be as simple as increasing your monthly payments. So if you're planning to tackle debt on your own, one option to consider is the debt snowball method. And I think this is probably my favorite of the methods, but that's my own personal view. This approach focuses on paying off debts from smallest balance to the largest, which helps you build momentum as you go, which is where the snowball piece comes in. You kind of rolling downhill and you're gaining momentum. So you're going to start by making the minimum payment on every single one of your accounts, and then put any extra money towards your smallest balance. So once that debt is paid off, take what you were paying extra from that smaller balance and then move on to the next smallest balance. And then you just keep going until all of those debts are paid off. The key with this is staying consistent. As each balance disappears, you'll free up more money to apply to the next one. So a lot of people find this method motivating because you can see progress early and it builds your confidence along the way. Kind of why it's the one that I prefer, but it may not work for everybody. You can also consider the debt avalanche method. So with this approach, you make the minimum payment on all your debts and put any extra money toward the debt with the highest interest rate. So while the snowball method focuses on paying balances from smallest to largest, the avalanche method targets the debts from highest interest rate to lowest interest rate. That can help you save more money on interest over time, especially if you're consistent. Finally, you could approach each of your creditors and ask if they offer any internal hardship programs or promotions to help lower interest rates and stop late fees and allow you to pay the debt off faster. And make sure you're keeping track of the conversations that you're having with creditors, including like when you speak with them, the name of the person you spoke with, and what you agreed to. Review your budget to ensure what you're agreeing to is not something that is unrealistic, so you can make sure you follow through. As I mentioned earlier, every option has unique pros and cons, which we'll look at with each option we discussed today. Pros of all three of these on your own options are that there are no financial costs to implement them. You also won't need to go through a full application or an underwriting process. Some creditors may ask for basic information to see if you qualify for that hardship program, but it's typically much simpler and less in-depth than applying for a loan. In general, when you use these as intended, these options typically have little to no negative impact on your credit and may even allow you to keep your accounts open if that's your goal. Be sure to ask your creditor about this if you're considering a hardship option. It's important to note that tackling debt on your own can come with challenges as well. Obviously, like anything else, it requires strong self-discipline and consistency, especially when there are constantly temptations around you to spend in other areas and then lose momentum along the way, or even start racking up more debt. If you're considering reaching out to your creditors for hardship options, just be sure to factor in the time it takes to make those calls, as well as your comfort level with having those conversations, because these can be tough conversations to have. It's also important to remember that each creditor decides what they can offer, if anything, and whether these options are short or long term. In some cases, creditors may freeze or even close an account as part of a hardship program. And that, with the hardship program having your credit cards closed, reduces your total available credit and actually can have a negative impact on your credit score. So another option, especially for those of people who don't have enough money left over each month, increasing your payments isn't in the cards if you're barely breaking even, or just maybe if you're running short. So option number 2 is a debt consolidation loan. Debt consolidation can come in many different forms. So the intent is to borrow money, use that money to pay off other debts, and then have one monthly payment instead of multiples, and then to one lender and not having to pay different creditors. Consolidation loan can be an unsecured loan, which means it doesn't require any collateral like a home or a vehicle. Instead, approval is based on factors like your credit score, income, and overall financial profile. With this type of loan, you can combine multiple debts into one new loan with a single monthly payment, which can really simplify your finances and make it easier to stay organized. In some cases, you may also qualify for a lower interest rate, which can help reduce the total amount you pay over time. However, those rates and terms will vary depending on your credit history and the lender that you choose. It's important to keep in mind that while consolidation can make your payments more manageable, it doesn't reduce the amount of debt you owe. So your success depends on staying consistent with your payments and avoiding taking on new debt while you're paying down the loan. Another option is a secured consolidation loan. This means you use something of value, like your home or a vehicle, as collateral in case you're unable to make the payment. So a common example would be a home equity loan, a home equity line of credit, or a title loan. These options can sometimes offer lower interest rates, but it's important to fully understand the terms and what's at risk. If you fall behind on those payments, you could lose the asset as your collateral. So if you really are you don't want to lose your home or don't want to lose your vehicle, make sure that you're able to afford those monthly payments. One of the pros of debt consolidation loans is that you know what your monthly payment will be and how long it will take you to repay that loan. Whereas credit cards, it's a harder thing to know. And if you ever look at your credit card statement and you see if you make your monthly minimum payment and then look at the amount of time it could take to pay off if you don't even charge anything else, it can be really overwhelming. So that's where these debt consolidation loan options come in really handy. So the goal of a consolidation loan is typically to secure a lower interest rate, which can help you reduce the overall cost of your debt and ideally lower your total monthly payment compared to what you were paying before. And with this option, your accounts may not be closed when you pay off those balances with a consolidation loan. Although it depends on your lender, there's a chance that there may be. So be sure to ask this question if you're exploring a debt consolidation loan. This may be a con, like I mentioned earlier. If you don't stop using those accounts and you start acquiring more debt, and then all of a sudden you find yourself with the debt consolidation loan payment, and now you also have credit card payments on top of it. On the flip side, here's a couple of other things to keep in mind. Since it's a loan, you'll have to go through the application process and have the underwriting and all of that. So factors like your income, assets, employment history, and credit and the amount of debt you have compared to your income are typically going to take into strong consideration. A debt consolidation loan may have a temporary negative impact on your credit due to having a new inquiry and then the addition of a new account, which brings down the average age of your accounts, which is part of what makes up your credit score. However, over time, making consistent on-time payments can help build your credit and potentially improve your overall score. So one of those short-term pain for long-term gain. One of the most important things to consider is the risk involved with secured loans. So if you're using a secured loan, you're putting up collateral, such as your home or your vehicle, which can be lost if you fall behind on payments. Because of this, it's important to move forward with caution, especially if there's any uncertainty about your ability to make consistent payments. While secured loans often offer lower interest rates due to less risk for the lender, they shift that risk over to you. So for example, if you use a home equity loan or a line of credit to consolidate debt, your home is now tied to that loan. So if something changes financially and you're unable to keep up with those payments, your home could be at risk of foreclosure. Be sure to fully understand the terms and carefully weigh both the potential benefits and the risks before deciding if this option is right for you. Up next, we have debt settlement, which can also sometimes be known as debt relief. If you looked on the internet for debt help, you've most likely seen a settlement company's ad, or you may have seen their ads on TV late at night. In general, this is a solution that is typically best used to help someone work on cleaning up debt after it's already in collections, although sometimes it's used for people with open accounts as well. So debt settlement is when you and a creditor agree to pay back less than the full amount you owe and the remaining balance is forgiven. For example, if you owe $5,000, the creditor might agree to accept $3,500 as a settlement and forgive the remaining $1,500. This can reduce the total amount you pay, but it's important to understand that there may be trade-offs and potential impacts to your credit to consider. I mentioned debt settlement or debt relief companies, but you can also choose to attempt to negotiate a settlement on your own. It's up to your creditor's discretion if they're willing to negotiate and what a settlement offer could look like. It'll typically be much easier if you already have the funds to negotiate and pay immediately, and if the account is already past due. So people are often most successful negotiating settlements on collections accounts. Make sure you obtain any settlement offers your creditor agrees to in writing, and make sure you know how they report this to the credit bureaus. Settlements may save you money if you're able to successfully negotiate a lower balance. If you enter into a payment plan or work with a debt settlement company on accounts that you're currently paying, your monthly payment may be lower than what you're paying now. And again, a settlement can be an option to resolve outstanding collection balances faster. It can also be an option to avoid more drastic or last resort options like non-payment or bankruptcy. But it's also important to keep several things in mind if you're considering debt settlement. So first of all, not all creditors are willing to participate in a debt settlement program or negotiate a settlement with you or with a debt settlement company working on your behalf. If you include accounts that are still open and active in a debt settlement program, those accounts will typically become past due. So this is because most debt settlement companies don't make your payments to your creditors right away. Instead, they collect your monthly payments and hold them until enough money builds to offer a lump sum settlement. Once that amount is reached, they will attempt to negotiate with the creditor. It's important to remember that creditors are not required to negotiate and may choose not to participate. In the meantime, since your payments are not being made, those accounts will usually become delinquent. As this happens, those accounts may be closed, late fees and interest can continue to build, and you may start receiving frequent collections calls. Because creditors are often unaware of the program in the early stages, this can be really stressful and unpredictable. As your payments fall past due and start to grow and your balances are growing with added interest and fees, it can have a real negative impact on your credit score. Your payment history and the amounts of debt you owe are the two of the biggest factors that make up your credit score. So those missed payments can quickly add up and really bring down your score. If your accounts become seriously delinquent, creditors may send them over to collections or take legal action to recover what is owed. So if you're pursuing debt settlement, it's especially important to pay close attention to your mail. Be sure to respond promptly to any important notices, especially legal documents or court summons, as ignoring them can make the situation more difficult to resolve. So while negotiating a lower payoff upfront may sound like a great way to save money, it's also important to consider the full picture. Debt settlement companies typically charge fees for their services, and as we discussed, those interest and late fees will continue to build on past due accounts during the process. In addition, if a creditor chooses not to negotiate, you will still be responsible for the full balance, which may now be higher than when you started. There can also be a long-term impact to your credit. So a lower credit score will make it more difficult or more expensive to borrow in the future, as you may only qualify for higher interest rates or subprime lending options. So make sure you take the time to weigh both the potential savings and the risks before you decide if this is the right path for you. Finally, if a creditor does negotiate a settlement, there may be a tax liability on the portion you weren't required to pay, as the IRS considers this a form of income. So I highly recommend that you speak to a tax professional if you're considering settlement to make sure you have a clear understanding of a potential tax liability. Again, there's a time and a place for debt settlement that makes sense, especially if you're trying to resolve some old collections accounts. But a lot of people are not made aware of what they were signing up for with a debt settlement company and wish they had more information like this before enrolling open accounts in a debt settlement program. All right, we got option number 4, which is bankruptcy, which is definitely one of your last resorts. So bankruptcy is a legal process through which people who cannot repay their debts to creditors may seek relief for some or all of their debts. Although you can file bankruptcy without an attorney, it's typically not recommended. Bankruptcy should be reserved as a last resort after exploring all other options, as it has a long-term impact on your credit record. There are 2 main types of personal bankruptcy. The first is Chapter 13, which typically involves repaying all or a portion of your debt through a court-approved repayment plan over time. So there's also Chapter 7 bankruptcy, which typically allows debts to be discharged without requiring repayment. Talking with an attorney can help you understand which type you may be eligible for. Many bankruptcy attorneys will offer a free initial consultation to help you get some clarity on what filing bankruptcy may look like for you in your particular situation. So like anything else, there are pros and cons to consider with bankruptcy. One potential benefit is that filing may stop certain collections actions, such as wage garnishment, repossession, or foreclosure. It can also put a stop to collection calls, which can provide some immediate relief when you're really, really stressed out. Depending on the terms of the bankruptcy, you may end up paying less to creditors overall than you would through other repayment options. However, it's important to understand that there are upfront costs associated with filing for bankruptcy. It typically includes your attorney fees and then court filing costs. It's really important to weigh this carefully, especially if you're considering Chapter 13, since you may have these additional expenses on top of still repaying some or all of your debt through a structured plan. So taking time to fully understand both the short-term and long-term costs and commitments can help you decide if this path is the right fit for your situation. Your income and assets can play a key role in whether you qualify for bankruptcy and what the outcome may be. So in some cases, your income may be evaluated to determine which type of bankruptcy you're eligible to file. Your assets may also be reviewed to determine what can be protected and what, if anything, may need to be used to repay creditors. Because of this, the details of your financial situation can directly impact both your ability to file and how much of your debt may ultimately be discharged. Not all types of debt can be included or discharged through bankruptcy. So there's certain obligations such as some taxes, student loans, child support, and alimony. Those may still need to be repaid even after filing for bankruptcy. And it's important to know that bankruptcy can stay on your credit report for up to 10 years, which really impacts your ability to obtain future credit and the cost of obtaining that credit. It's not impossible to rebuild your credit after bankruptcy, but it's much more of an uphill battle. So again, it's important to weigh, especially in the instance of Chapter 13 bankruptcy, which still requires a debt repayment. If there is another option to repay the debt that can avoid the credit impact of bankruptcy, it's definitely worth exploring. So going back to either a debt consolidation loans or a debt settlement, making sure you evaluate that option is really important to avoid having a bankruptcy on your credit report for up to 10 years. So our final option that we're going to discuss today is a debt management plan, which is not the same as a debt settlement. This is probably the least known option out of the 5. And since it's not one a lot of people are aware of, we wanted to make sure you learn about it today. And I know I've been talking a lot, so I'm just going to take this minute here to pause, get a drink of water. And if you have any questions, you can just put them in the Q&A section, and I'd be happy to answer those for you. All right. So debt management plans are typically used for unsecured debt like credit cards, collections accounts, medical bills, and in some cases payday or personal loans, although these tend to be more case by case compared to credit cards and collections. So here at Maine Family Federal Credit Union, we partner with a nonprofit credit counseling agency called GreenPath Financial Wellness, who offers debt management plans to our members. Through a debt management plan, GreenPath will create a structured repayment plan to pay off the debt in full, and they reach out to your creditors on your behalf to potentially get lower interest rates and perhaps have things waived like late fees that the creditor will agree to. As you send your money to GreenPath, they send each creditor a payment on your behalf every month until that balance is paid back in full. So this is where it differs from that debt settlement program we talked about earlier. GreenPath does not negotiate the balances themselves. It's just the terms of the debt repayment are negotiated. So your most likely your interest rate and any fees that you may be incurring. And those creditors are involved every step of the way. GreenPath will send your creditors a proposal. The creditors will agree to accept a certain payment and offer a certain interest rate until the debt is paid in full, and they continue to get a payment from you every month. One of the pros of a debt management plan is that there are no minimum credit score or approval requirements like there would be with a loan. Another key benefit is that the debt management plan is typically structured to pay the full debt balances owed, usually within 5 years. So you see the light at the end of the tunnel with a debt management plan. A debt management plan also offers the benefit of getting all of that money that you owe to one place. So you make a deposit to GreenPath, and they distributed that payment to your creditors on your behalf every month. So it makes it a lot easier for you. So you're not juggling multiple payments and due dates and trying to remember, did I pay this? Did I not pay this? When is this bill due? GreenPath will handle all of that for you. Finally, on these debt management plans, one of the biggest advantages is the potential benefits creditors may offer through the program. So each creditor may offer different terms. Your plan can vary depending on who you owe. Many creditors are willing to significantly reduce interest rates through a debt management plan. So those lower interest rates means more of your payment goes to the principal instead of interest, which can reduce your monthly payment and help you pay off your debt in full, typically in 5 years or less. As with all the other options we've discussed, there are some important things that you want to weigh and keep in mind, including the fact that the creditor will close those accounts that are included in a debt management plan. This may not necessarily all be negative. Having those cards closed may be a pro, because if your goal is to become debt-free and not ever get back in debt, not having access to those credit cards may be a good thing if you have a hard time controlling spending. When all of those cards do close at once, it can lead to an initial negative impact on your credit. However, if your accounts have already started to fall past due or are maxed out, you have more likely already seen most of that negative impact, and really you can only go up from there. As your balances are paid off more aggressively and your positive payment history builds, many people who use a debt management plan to pay off their debt actually see their credit score increase over the life of the program, even if there is that initial negative impact as you get started. If you're considering a debt management plan or concerned about credit impact, your GreenPath counselor will talk you through all of that in more detail, and they'll tell you what it will look like for your specific credit situation and help you develop a plan to rebuild your credit score as soon as possible. I do also want to clarify that while many creditors, especially some of the major credit card companies, would officially agree to work with a debt management plan, some of them may not. But they will still typically accept the payments and post them towards your balance. So even if they don't lower your rates or fees, you're still simplifying your payments every month by giving all of that money to GreenPath, and they make those payments on your behalf. Finally, while you're having a conversation about the best way for you to tackle your debt, I do want you to be aware that there is typically a setup and a monthly maintenance fee associated with people who are enrolling in a debt management plan. Those fees they're actually regulated by Maine state law. So that initial fee to enroll must not exceed $75, and the monthly fee that you pay must not exceed $40. So any fee for the debt management plan is significantly outweighed by the savings that you obtain through your credit or concessions. So your Green Path counselor will talk this through with you in detail to make sure that debt management plan is the right option for you. They're not going to have you sign up for this if they don't think that it's the best option. So I know I just threw a lot of information at you, but I hope at least one of these options has captured your attention and it feels like it may be a realistic option for you. Regardless of which option you choose, there's a few tips that will be important to stay on track towards your goal of paying down your debt. First step is to develop a budget or a spending plan. Spending plan sounds a little bit better than a budget. Your spending plan is simply a way to understand where your money is going and make sure it's being used in a way that actually supports your financial goals. So if you're somebody who spends way too much money on Amazon or goes to Dunkin' or Roma Joe's or Starbucks too often, this is a good way for you to see that on paper, whether it's actually on paper or on a spreadsheet or an app. It puts that information in front of you, and it can be shocking to see like what kind of money that you're spending that's really maybe not necessary. So creating that plan is important, but sticking to it is what really makes the difference. Building that consistency will be key to successfully paying off your debt. It's like exercise, right? Like it's hard to stick to it, but once you know that you stick to it, you feel so much better and your body reaps the benefits. Same thing with sticking to consistently paying down your debt. It's also important that you track your spending to make sure you're in alignment with your budget and your financial goals. So you can do this in multiple ways. You can either use the cash envelope system where you are setting aside cash for specific expenses, say, mortgage or rent, groceries, insurance, vehicle payments, etc. So you have different envelopes and you put that cash in there and you know exactly where that money is going to go each month. You can do it old school and have paper and pencil. You can use spreadsheets. Google Sheets actually has some really good budget spreadsheets so that you don't have to build those on your own. There are budgeting apps out there that you can use. So whatever works for you, just find that way that works the best and just commit to keeping a close eye on where every dollar is going. It may be helpful to schedule some time each week to sit down and actually track all of your spending. You don't want to wait too long because the longer you wait, the more, it gets a little harder because you've got things going in all these different places. But try to schedule some time every week to sit down and say, okay, Saturday morning, here I am. I'm going to go through my bank statements and I'm going to write down where all of my money went. Writing it down and seeing it, whether it's in print or on a screen, really, really brings it home of what you're doing with your money, and it can help you stay on track so much easier. So I also encourage you to have some savings to fall back on in an emergency before you start to really aggressively tackle your debt. I know it sounds a little counterintuitive, but you don't want to put yourself in a situation where you have to take out more debt to cover an emergency. And if you're looking for an easy way to do that, we have what we call the Change is Good account, where you use your Maine family debit card, and every time you make a purchase, it rounds up to the nearest dollar, and that extra change is deposited into a specific savings account just to build emergency savings. You can use it for whatever you want, but the point is to build an emergency savings. And it pays a pretty high yield on that first $500 to really get you in a good place faster than you would be with a regular savings account. So if that's something you want to look into, if you use your debit card frequently, it may be a really good option for you. You also, of course, want to look for opportunities to reduce expenses or bring in more money with the purpose of putting those extra funds toward paying off your debt quicker. So cutting out expenses that are considered more of a luxury or picking up extra shifts or a side gig is not it's not something you're going to have to do forever. It's a temporary sacrifice to help you reach your goal quicker. Again, like I said earlier, kind of short-term pain for long-term gain. So finally, we're getting close to the end of this presentation, but my biggest tip to stay on track is know why you are doing this. If you don't know why you're doing this, you're not going to stick to it. So set clear goals and make sure they're realistic and attainable. You don't want to set something that's so high that you're going to lose motivation quickly. So it's best to take that big goal that you have and create smaller goals and milestones so that you can stay motivated. And if it helps, you can create, a spreadsheet with those goals. You can make a paper chart, whatever works for you to stay motivated. That's what you need to do to keep yourself going. If you know what you're working towards and you have a plan, how you can get there realistically, you want to make sure you celebrate your success every step of the way. So I know I already talked about GreenPath a little bit and their debt management plans, but they also have financial counselors that can help you look at your specific financial situation, and they can help you decide which is the best option for you to pay off your debt. So like I mentioned earlier, GreenPath is a nonprofit organization that we partner with to provide resources to help you lead a financially healthy life. Reaching out to them is at no cost to you. Just let them know that Maine Family referred you, and they will have a counselor. They are open. Their hours are later than our normal hours. They are all certified financial counselors, so they'll conduct a free confidential assessment with you. They'll take a look at your budget. They'll work with you to develop an action plan, and they can also talk to you about your other financial concerns if you have any questions about credit or housing or student loans or any other debt. So if you want to speak with a financial wellness expert, you can call GreenPath at the number on the screen, or you can also visit our website. I will be sending these links and some other resources in a follow-up email along with the recording, so you can go back and you can watch it again if you need to. You can share it with somebody else who may benefit. But these resources will be available to you to help you get started on the path to becoming debt-free. So that is all I have. Does anyone have any questions before we finish? I don't see anything in the Q&A, but I just wanted to give a little bit of time just in case you have questions. Linda, you have a question. Microphones are all muted. Are you able to type it into the Q&A? Welcome. All right, Linda, I see you're typing. Emily, you're welcome for this information. I hope it was really helpful. I know I went through a lot in a very short period of time. If Linda says she has a bunch of Q&A questions under the bubble, I am not seeing any. Oh, here we go. Oh, okay. I do see them now. I'm sorry about that. So let's go back here. Does Maine Family offer members any kind of debt consolidation program? Yes. So we do offer personal loans that you can use to consolidate debt. It's not like a specific debt consolidation program, but we do offer loan products that will help you take multiple payments and put them into one payment. Next question, how does one sign up for GreenPath? I think I covered that one, but again, if you go to our website, it's a free resource for you. You do not have to pay unless you decide to enroll in a debt management plan. They will talk to you via phone, they will do like a Zoom call, whatever works best for you. It's nice because their hours are a little bit later. They're actually based in the Midwest. So they have people across the country. So they have some counselors who live in California, some counselors who live here on the East Coast, and they can work with your schedule to make sure that you are getting what you need. So filing, so Linda asked, does Maine Family offer members any kind of help with filing for bankruptcy? We cannot offer that kind of advice. That is something that you would really need to speak with an attorney for, because it's a legal proceeding. GreenPath can definitely talk to you about that and let you know if that's an option for you or if there's a better way to take care of it. So maybe maybe bankruptcy is not the way you want to go, because I really think it's the last resort. Maybe a debt management plan is better for your particular situation. This is a good question. How can one improve their credit score after filing any kind of debt consolidation? Making on-time payments is going to be your biggest ally in improving your credit score. So as long as you're making those payments for that debt consolidation on time, that will help boost your score over time. Also, not incurring any new debt. So if you are able to close any of those cards that you're consolidating, you won't be able to incur new debt, which will obviously reduce the amount of money you owe. So that's I think the biggest key to improving your credit score is making those on-time payments. All right, finally, I got to your last one. You had a lot of good questions, Linda. So signing up for the Changes Good Savings account, you can reach out to member services here at Maine Family and they can help you open that account. I really do think that there's not enough people who use it. It's a super simple way to build your savings. I would love to see more people have this account. So just give us a call and reach out to member services and just let them know that you're interested in Changes Good and they can get that started for you. Hopefully I answered everything there. I don't know how I missed them earlier. They weren't there. They just showed up afterwards, but I really, really appreciate all those amazing questions. And I really, really appreciate all of your time today. I think this was a great topic. It's something that it applies to a lot of people. And I hope that you're able to take this information and either create a plan on your own or reach out to our partners at GreenPath to help you figure out the best way to move forward to pay down your debt. It's hard. I get it. I've been there. I know it is so hard to do it, but as long as you have that plan and you're celebrating those milestones and you just stick with it, you'll be great. So thank you. Oh, you're welcome. I love doing financial education like this. I think this is really, really important resource for members and the community to have. And I am so glad that I am able to take time out of my day to work with all of you. If you have any questions, please do reach out. You can reach out to marketing@mainfamilyfcu.com if you have some questions. Or again, I will be following up with an email after this with the recording and a bunch of resources. And if you want to talk to GreenPath, they are amazing. Again, free, it costs you nothing unless you go with a debt management plan, but they will help you figure out the best options for you and becoming debt free. That's all I have for today. We have a little bit of extra time, which that's good that we were less than an hour. So you have some time to get back to your day. But again, I really appreciate you taking the time out of your day to spend with me. And hopefully I will see you at another webinar soon. Thank you. Have a great day.